This is Sarah Carlson. I'm the founder of Fulcrum Financial Group. Thank you so much for being with us today on our webinar. We have a very special guest with us, Dr. Jeffrey Roach with LPL. I first of all wanted to, before I introduce Jeffrey, wanted to make sure you knew that we are using Slido. So I don't know how many of you have used Slido before, but Slido is an opportunity to ask questions. And you go to slido.com, SLIDO.com, and enter in FFG 20224. So like Fulcrum Financial Group 2024. And then you'll be able to ask questions directly to us during this presentation. So we're anticipating our webinar will take about an hour in length. Jeffrey's going to share commentary for about 25 minutes, and then we're going to have question and answer. So thank you so much for coming. Thank you to the LPL team. We had Megan, Jonna, Travis, and Lacey all helping to make this webinar possible. And this is very special. We have you in the audience. Some of you are part of the Fulcrum family, and some of you, this is probably your first introduction. We're so honored to have Dr. Jeffrey Roach. So Dr. Jeffrey Roach is the chief economist at LPL, and LPL's the largest independent broker-dealer in the country. Being independent means they don't produce product. And we rely heavily on the smart people in our research team under Jeffrey's guidance to help give us good information so we can help our clients make the right decisions to help get them to their financial goals. Jeffrey has an impressive background. I was impressed to know he has a BA from Bob Jones University in both math and physics, which both are very difficult to get. He has his PhD from Clemson University in economics, and he also has research degrees in equity markets through Harvard. So we're so fortunate to have Jeffrey be part of our team. He's a father of two. He has two teenagers at home, and today I learned he's a musician. Like, this man is very impressive on all fronts. He's a singer. He also has toured internationally playing the trumpet and guitar. So he's using both parts of his brain when he's helping us make decisions. And in part why we're able to help you make such good financial decisions is because of smart people like Jeffrey. So Jeffrey, thank you so much for coming and being part of our webinar and talking with us today.
Well, Sarah, it's a real privilege. I sit here in Charlotte, North Carolina, not as beautiful as the Pacific Northwest. I lived in Silicon Valley for a little bit, so not in person with you, but I kind of wish I were. But glad to be here with you virtually.
Thank you. There's so much going on right now in the markets at the beginning of 2024. I've seen you present in person a couple of times, been very impressed with your ability to pivot, respond, and give us the best ideas from your research team. So can you give us an overview of what your team's thinking about this year ahead and coming off of a pretty impressive 2023?
Well, I'd love to do that. And also, Sarah, as you and I've spoken, we're very excited about having a Q&A opportunities later within the hour. And so I'll set the stage, and really the audience, feel free to jot down any comments, any questions while I talk for the next few moments. And if there's something that I said that resonates or maybe doesn't resonate with you, we can talk about that in the latter part of this time together during the Q&A. So feel free. Really, the fun thing about economics, and of course, you know, my mom always wonders, I say fun and economics in the same sentence. That doesn't seem right, but it really is. The fun thing about economics is that it really can apply to just about any area It's very philosophical, right? I think of an economist, a good one should be 1/3 mathematician, 1/3 philosopher, thinking about what's happening and looking at the numbers, but 1/3 storyteller. There's that component of saying, well, what is the market narrative? And so that's what we'll do today together, Sarah, with your team. We'll have a story time, as it were, thinking about the market narrative. So the best way, I think, to think about 2024 is to think all of the subtleties of 2023 will become more pronounced. So you think about this past year, and it was really a tale of two economies, but you really couldn't tell, right? So the first half of 2023, the first quarter was gangbusters. The economy grew very strong. The middle of the year, we had a couple shocks, right, from banking and from international geopolitical problems. And then the third quarter, again, a shocker of really strong growth on the headlines. And one of the stories that I've been highlighting for our clients and those that look to us for guidance is that you have to look below the headlines. So the subtleties of 23 will be more pronounced in 24. So let's get back to the strong growth component. We had a lot of strong growth in 23, which again, let's go back one more year, 2022. We had 2 consecutive quarters of negative growth the first half of 2022. So you thought, okay, recession risk, markets, I wouldn't say crashed, but tanked, right? Down pretty hard, hitting a low in October of 2022, thinking that we're in recession. One of the things I like to tell people, a recession often occurs with 2 consecutive quarters, but 2 consecutive quarters is not the official definition. I tell folks, you think about the 3 Ds for a recession: depth, diffusion, duration, meaning you have to have the economy decline, the depth being deep enough. Duration has to last more than a few months. Diffusion means the contraction has to be across all sectors of the economy. That was not true in 2022. You had 2022, very strong consumer growth. We had negative quarters because of trade and because of inventories, as businesses were realigning and managing inventories. So no recession, but markets really priced it in. Then you could think 2023, it was all about the luxury consumer. That's 2023 is where we started to see a little bit of these murmurings of the lower income consumer having a lot more trouble than the upper income consumer. Well, latter half of 2023, so we prep for 2024, and I'll talk about how we want to think about this year. We started to see a little more pressure even on the upper income households. That was one of the reasons why I'm still in somewhat of the minority, meaning that I think we could see a fairly dramatic slowdown in the first part of this year, 2024. Not going to be a great recession like the great financial crisis. It's not going to be, a massive shock like we've seen in other periods of recession, but we could see some slowdown because we're starting to see a little bit of pressure even on the upper income, meaning they're using credit to fund spending habits more than they typically do. But tale of two economies. Let's get a little bit below the headlines. Again, that's kind of one of the themes that we've had, and I'll illustrate it with a couple things. 1, labor market, and 2, housing market, and then we'll go internationally, talk globally. So one of the challenges, I don't know, Sarah, your listeners, what their median age might be, whether they're thinking about a home, whether their kids, helping their kids think about a home. 2024 may be a time, starting to tell some of my friends as they ask me professional advice, might be a time to start saying, hey, this might be the time to buy a home if you've been waiting and you didn't get in early enough. I moved back from Silicon Valley to Charlotte in 2021, early 21. We negotiated our house in December 2020. So very, very thankful on the timing of that. But that's not, everybody didn't do that. Well, rates up, borrowing costs expensive, housing expensive. Well, why would I say 2024 might be a year to buy a home? My answer is we'll look past the headlines and say, look, there's actually two different experiences going on in the housing market. New home sales, pretty attractive. Existing home sales, pretty poor still. And it makes sense once you kind of think what's the story behind it. Let's dissect the new home market. So Pulte Homes, for example, Lennar, some of those bigger DR Horton, some of those bigger names have the ability to finance within their own firm, right? So you can actually get a good full 1%, if not more, discount. And at the same time, median prices for new homes hasn't been as bad as what I'm going to now pivot to this other portion of the housing market, the existing homes. So take me, for example, bought early on, got the 2.5% mortgage. I am never moving, at least, not anytime soon, right? You could kind of say it, the golden handcuffs. So you have the existing home side of the market where inventory is extremely low. And we know from Econ 101, low inventory, low supply, high prices. Other side of the kind of the market, new homes, a lot more activity, a lot more inventory, a lot of building, would you believe, in the last year, and median price and borrowing, especially if you go through a builder, very different and a little more favorable for the buyer. So that's the tale of two economies illustrated by housing. Let's talk briefly about the tale of two economies is illustrated by labor market. Same idea actually going on here. We've had some sectors of the economy recover and even get close to pre-COVID trend growth in job creation. However, even as of last Friday's jobs report, comes out once a month, typically on the first Friday of the month, 8:30 Eastern time. The government releases that report. So last Friday, we got December's numbers. We're still below pandemic levels in leisure and hospitality. And it kind of makes sense when you think about it. You go to the restaurant, you go to the hotel, they're understaffed. And you can kind of see where there's certain sectors of the economy that haven't even, I should say, certain sectors of the job market specifically, have not yet fully recovered than other sectors since the pandemic really came in earnest. March 2020 is kind of my point on that. So labor market's been kind of important to kind of look beneath the headlines. Housing market's been, consumer spending and inflation has been as well. So let's just talk inflation. Same idea, tale of two economies within the inflation metrics. Well, inflation on goods prices, particularly durable goods like cars, furniture, appliances, a lot of those prices have come off really dramatically. In fact, not only decelerated, and Sarah, the challenge on this, when you talk about inflation, it's kind of like talking about government budgets. Inflation coming down, well, it's just less hot. It's still growing, but less hot. So decelerating is the right way to kind of think about that. But in terms of durable goods, inflation has actually been negative for some of those categories, actual outright declines. Interestingly enough, some of the luxury goods, watches, for example, there's a shortage for a while, just like in semiconductors and cars, there's a shortage of luxury watches for a while. And it was quite the thing, right? Everybody wanted a Rolex or whatever the luxury watch was. It's very difficult to find something like that in 2023. That's shifting as well. So the tale of two economies with inflation metrics, durable goods, even non-durable goods like apparel. And then you flip to the services. Services still been somewhat nagging in terms of the inflation pressure, particularly on the insurance services side. So I think I'll take a little bit of a detour here, Sarah, to say, okay, we're thinking macro picture, but let's take a little bit of a footnote, put a footnote on here and saying, well, there are really interesting investment opportunities when you think about looking below the headlines, right? So you could say, the value of active management, for example. You might say, those that are servicing some parts of the housing market having trouble. Look at some of the stock prices in Pulte and Lennar and DR Horton, some of those names I mentioned earlier. A lot different scenario, particularly the last quarter of last year. A little bit choppy the first week of this year, and probably coming out of the Christmas break. But it's very, very, very important. In fact, I mean, for the clients and folks on the call, just to highlight with you, Sarah, the whenever you have a highly nuanced market and a highly nuanced, situation within the macro landscape, it really behooves folks to say, I need someone to walk alongside with me. The value of an advisor, a planner to help people say, okay, what to do about this. You can't just say, well, I'll put it in the market. Well, the market is too broad. Just like GDP, too broad. Got to get, you got to get deeper. So that was my little footnote. Going back to the big story again, same idea, even when you go outside the US, this idea where, needing to go below the headlines, internationals, for example. So, anybody that's in the markets, I say the markets for any period of time, there's always an appetite to think, okay, what about Latin America? What about Asia? What about the BRICS? Back in the day, it was the BRICS. That's kind of old news now. But in the late 90s, early 2000s, you're thinking about the dramatic growth in some countries. Even internationally, you think there's things that are very, very different. India, pretty positive. Japan, pretty positive. Think about China, not so much. A lot more pressures, even in some of the areas that we see in Asia. So, in fact, I was just talking to a friend of mine. I started my career on the trading floor at Bank of America. Great opportunity for a newly minted grad student. Of course, starting on the trading floor, I thought, I don't even know what they're talking. Are they even speaking English? I had textbook knowledge, but I was learning how to put, this stuff actually into work. Well, in the late, I guess 2005-ish, 2006, Bank of America, during the time I was there, bought a sizable chunk of the China Construction Bank. It was one of the first times where, a major bank in the U.S. was putting so much money and buying actual equity stake in a place like China. That kind of risk. But what was interesting was, the challenges of an emerging economy are that there's so many different growth stages. You think about the last 2 or 3 decades been phenomenal, but really over the last several years, it's been a little bit sluggish, meaning, okay, we know China, for example, has a massive real estate problem, has a geopolitical problem. We don't know what they're actually going to do with some of the other political components, kind of like when you think about investing in Russia, same idea. But I think with emerging markets, there are areas that you have to avoid. And then there are other areas you say, okay, maybe it's worth dipping the toe in the waters, as it were. Like I said, India is one of them. So I think going back to kind of my overarching theme, and we can open up for Q&A, I think, pretty soon here, Sarah, but the overarching theme is the subtleties of 23 might become a little more pronounced in 24. Now, before we open up for Q&A, we haven't even talked about the Fed. We haven't talked about rates. We haven't talked about necessarily our S&P target. So let's get to that a little more granular. I think, I think 2024 clearly is going to be a year where yields are lower, not only yields on treasuries, but also borrowing costs, Fed funds target rate. Across the board, yields will dip as we go throughout the year. Perhaps not as much as maybe some people might think, but the direction is going to be downward. I would certainly make a bet on that. And I think that's a very safe position to be in, that rates will dip, go down in 2024. That in essence will help investors want to take a little more risk, put a little more risk on the table, meaning that we should have overall, when we sit December 2024, I think we'll see markets up. I think we'll probably have lived through somewhat of a short and shallow recession. If it's not a recession, maybe it's short and shallow, slow down close to zero. We think the economy will grow in 24. We think the markets will be up, say, maybe 7 to 8%. I think some on my team might say maybe a little bit hotter, but maybe a little bit choppy getting there, at least in the first half of the year. But the Fed's I think, going to say we're happy with where the inflation trajectory is. We're not saying that the battle is over, because it's going to take a while for them to see, and for investors to see inflation actually get to 2%, but we're going in the right direction. And that's going to certainly benefit the Fed, certainly benefit more of the riskier asset classes. In terms of the bond sector, it's been a tough 2 years now for bond investors. And that's been because of the confusion, like I said in my earlier comments, 22 being a recession, not so fast. 23 being so hot, well, not so fast. There's slowdown as well here. In fact, holiday sales was not quite as strong as people projected. So we're in for a little bit of choppiness, but again, for those who have been around long enough, this is not a great financial crisis. One more story, and then I'll turn it to you, Sarah. This is no joke. I told you this was 04, 05 when I was on the trading floor. One of my very first projects for the portfolio managers on the floor was to research two items, and they had pretty cool acronyms, and no one knew what those acronyms meant. And so they said, "Hey, here's the new guy from grad school. Get him on the project." CLOs and CDOs. So, if anybody knows that, CDO is collateralized debt obligation, CLO collateralized loan obligation, obviously connected to the subprime markets and all kinds of interesting things that went haywire going into 07. But I don't see that kind of behavior, that kind of trading and allocating behavior today, like I observed in real time in 04 and 05. So I think that's why it's really important to say, yes, headwinds, yes, some challenges, but I can't argue that's the same kind of level of the challenges and behaviors of 04, 05, 06. So with that story, I'll pass it to you, Sarah, and we can chat some more depending on what kind of questions you have. There's certainly a lot to talk about. I just highlighted just a few of my hot topics.
Thank you so much. That's such a great commentary and a good entry. We already have some questions coming through on Slido. So for those of you that want to ask a question of Jeffrey, go to slido.com, enter in FFG2024, and it will come through on a screen, and I can ask him directly for you. So one of the first questions that came through dovetails what you're talking about with bonds. And so that bonds have enjoyed recently better performance, but they're wondering, it's been the shorter term of the shorter term rates, like CD rates, have been really high, and the longer term rates less high. Can you talk about what you anticipate going forward on bonds, and whether or not, and it's a two-part question. They want to know if you think the Fed's going to raise rates or actually potentially lower them.
Yeah, I think so. I'll answer the question on the Fed and rates first, because it dovetails nicely into that other question on rates across the curve, including even on money markets. I think the Fed has been clear enough, and the data has been clear enough to suggest the Fed's done hiking. So they're past the outright hiking stage. They're in that wait and see stage, and I think the next move may be March, but that's probably only if the economy really slows more than people expect. Maybe they're meeting after March, not quite that early. They meet in January, by the way, typically 8 times a year. So it's not, perfectly, on a monthly cadence, but they meet in January, no change expected. March, there's a chance they cut in March, but that's if the economy slows enough. I think they hold, but the next meeting after the March meeting is a cut. I think they cut at least 4 or 5 times. They've communicated three 25 basis point cuts. The markets are saying, hey, maybe 6 or 7 25 basis point cuts. By the way, 25 basis points is 0.25%. Sarah, I'm sure you're like this too. We get used to speaking in our finance world and making sure our audience knows what we're talking about. 0.25%, 25 basis points. So the market's expecting the Fed to cut even more, but even outside of maybe their over exuberance about cuts, the next move will be outright cuts. So I think we end the year with a Fed funds close to 4.25. Maybe even a little bit lower. That's what some people are trading. The way that futures markets trade suggests a little bit lower. I think 4.25. That's still pretty nice for overall investing opportunities. So that leads me to the other question that was given, and that is, what do we think about bonds and the money market funds? So we're definitely going to see the money market cash and cash equivalents less attractive in 2024 because they'll be most susceptible to following that Fed funds cut. So as the Fed talks about cutting, that's going to lower a lot faster than, say, like a 10-year yield would. And so hence 2024, it's going to be about core bonds. It's going to be a lot less about cash. I think that's kind of a very, very practical takeaway. And people wanted to put a lot of money in cash in the past year and a half for obvious reasons. I think that's going to be done for this upcoming year.
Yeah, thank you. That dovetails nicely into this next question that was posted, because it says, what are your thoughts on a recession in 2024? Because we've, these last few years, that's been the buzzword, right? It's been the most psychologically challenging. As we look forward, we always think we're 2 months away from a recession.
I've been challenged by it myself. So in 2022, I thought recession was going to come in 2023. And lo and behold, we were surprised. By the way, it was interesting. In 2022, I was considered a little bit more rosy because I was going to say, hey, the recession's not going to be a bad one. I don't know if you all remember, Jamie Dimon talked about the hurricane. Remember,
Right.
good old Jamie Dimon. He's always going to say something that'll get markets rattled. He was talking about the hurricane that's coming. My point was, no. I've lived through the great financial crisis. This is no great financial crisis. So yeah, recession, but not bad. And I was being accused of being rosy, too rosy. Now what's funny, of course, I sit here saying, no, I think there's still those headwinds. Now it's like, well, no, you're too bearish. I was like, I haven't even changed at all. I'm just saying, eventually, and this is how I think it's helpful thinking through it. When the spending splurge ends, and consumers kind of say, okay, there's only so many times you can buy a washing machine and a refrigerator, right? So they've pulled forward a lot of that consumption on durable goods. Once the spending splurge ends, everybody went to Europe last year, me included. We all wanted to travel. Then you kind of have that technical setup for an economy to contract a little bit. So specific answer to the question about recession, I think there's a higher chance of recession in 24 than a lot of people are talking about. But what I want to highlight, though, is I think in a really unusual way, the markets have priced in a recession already. That's why it was so helpful to think as I was walking through it today in the context of the last 2 years. Market sold off in 22 because of recession fears. 23 was this confusion, but there was kind of these bubbling underneath the surface. So I think the markets have priced in a lot of that recession talk. I think businesses have prepared for that recession, that slowdown recession, meaning that a recession could happen, not going to be as bad as your typical recession. So post World War II, here's a stat for your audience, and that is post World War II, recessions are typically about 10 months long. We think it'll be shorter than that if we do fall in one. Hey, maybe we could be wrong, right? Maybe there's enough interest for stimulus again, right? Something that kind of helps, the soft patch, the softness of the consumer, and of course, not to overlook the importance of capital expenditures on the business side, which looks like things are softening there as well. But certainly any type of stimulus will soften the death. But outside of that, I think the consumer and the businesses have been preparing for a slowdown for so long because everybody's waiting for it for the last 2 years. It hasn't happened yet.
Yeah. The thing I love about recessions is eventually we will have one, and it's just part of the economic cycle, right? Nothing to be scared of.
Yeah, it's part. Yeah, just to follow up on that, it is part of the business cycle, right? I think of the you talked about my musician background. You think about when you go into the symphony, they at the very beginning they're tuning. It sounds horrid, right? You got the oboe playing the concert A, or their concert master comes out, stands, and everybody tunes. They play a first half intermission. What do? They retune again. A lot of times, especially if they're playing something intense like Wagner, they're going to tune again in intermission. It's going to sound terrible, but then they'll make some beautiful music again. So I think in the same way, you have that business cycle where, okay, inevitably, yes, there's times where there's expansion. There's times of the lean years, as it were, but there's still opportunities for investment. I think that's
Right.
kind of the takeaway.
Yep, absolutely. This next one is with the elections coming up with upon us, and this year, I mean, we're always cautioning our clients how much news they consume because there's a lot to be upset about, and going this election year and all the noise. What is there any guidance or feeling if it goes one way or the other, how that would affect the markets?
Well, I think the thing to look at is, the makeup of the Senate and the House. That's going to be more important than who's in the White House. We do know that when there's a tension, always seems to be tension in the Beltway, inside the Beltway, but a divided Congress is always good for markets, right? There's kind of that give and take. So that's certainly something that you can say going into it, knowing how markets will react. I think one of the real practical things to think about is you have what I think, some really good economics embedded in the Tax Cut and Jobs Act of 2017, meaning there is bonus depreciation. That's one thing that I'm a huge fan of. I remember, I'm not an accountant, but I remember that really being talked about during the depths of the great financial crisis, and I saw how well it worked. So, bonus depreciation, things of that nature, where you're encouraging businesses to be productive, and that's long term. That's a great thing. So watch what happens there. I think we have until the end of, I think, 2025, right? So it's when some of those things expire. I think one of the things I like to talk about, because this gets highly debatable and political and partisan when you think about tax cuts, things of that nature. What I like to say, ultimately, it's not tax cuts nor cutting spending, or however you want to think about those kind of high level things. The best way to get out of a problem, whether it's like deficit or whether it's just challenges from just oversupply. We got to fund all this, all this debt. And that is having anything that's pro-growth, whatever that pro-growth policy is. In fact, this might be a little bit way off from where we want to go. But when I was doing a little deeper dive in last week's payrolls report, I was looking at the number of foreign-born workers that are not in the labor force. And I thought, okay, that can get real highly political. But the key is, how do you get whatever it is, where in any way you can get an economy growing in a stable way, that's the best bang for your buck. You think about 2001, the way that we got to a surplus on federal spending. You got there because there was pro-growth policies, good for businesses, good for consumers to say, hey, I want to work hard, and I'm gonna be able to get benefits from my work. It's kind of like how I try to teach my teenagers. Work is good. The blessings of the living in this country is, for the most part, you can get benefit. You can reap the rewards of hard work, and that's kind of the key. That's kind of the key for how we get through the election process and what policy might look like going into the next several years.
Yeah, it's going to be a wild ride, I'm sure. So this next question, there's been so much growth in large cap growth and technology. How do you see AI and that whole space? There certainly is a lot of hype around it. Will it continue to deliver efficiencies that make us more productive and continue to help us grow as an economy?
Yeah, I think there's still so much to say and so much development to happen before you can be too opinionated on that. But I think overall, the way I see it is this. I see, okay, we're an aging population, meaning that more and more people are going to be out of the labor force, retiring, smaller labor force supporting a greater group of people retired. No questions asked on that one. That's been a trend for a long time. I think AI can actually be a way in which we can say, hey, maybe we can make up for the shrinking labor force by having the ability, out of the AI, the generative AI opportunities. And I'm always testing those things out. It changes by the minute, the way that things are developing, and it's fascinating. I encourage everybody to kind of play around with what the tools are out there. It highlights its limitations. So I'll write commentary on what I'm seeing in the markets and how things are responding to, say, like Fed policy, and then I'll throw my comments in a chat GPT kind of engine, and I read what it spits out. I'm thinking, okay, it's not there yet. It is not there, because there's so much nuanced aspects of what's happening. And that was kind of the point of what I was highlighting to you just in the last 30 minutes here, the nuanced idea of tail of two economies. So I'm hopeful. One thing that I really enjoyed when I was an economist at Visa in Silicon Valley is the really fascinating work happening there. We are a country of creative people, and that's a lot of fun to see what's happening, what's being developed. I'm bullish overall on the AI.
That's helpful. I am too. That's great. Okay, so this is a fun one to an FYI. One of our viewers wants you to know that Spokane now has a direct flight to Charlotte, and starting in June on American Airlines, and so they think you should come to Spokane to visit in person. I think that's a great idea. I like that.
Well, I am so my wife and I have camped on the Appalachian Trail that goes from Georgia to Maine. And of course, you have your better trail. And I would love to set foot on that. I don't remember if we were on the official trail. We did some activities in Northern California going to a dude ranch, but I don't think we were right quite there on hitting your Pacific Northwest trail. But that's funny. Well, I appreciate the invitation.
That's great. Yeah. So whether you come to our office here in Spokane or our new office in Colorado, there's bound to be good hiking both of those places. So
I could see I would be very happy to come and meet your family in person and talk more markets and economy in person. Love it.
yeah. Well, thank you so much for joining us today. We're going to have this is being recorded. So if anybody watching this would like to have a link to send to someone you know that you think this would be helpful, just reach out to us so we can send that to you. And Jeffrey, thank you so much for your leadership on the research team. We have here at Fulcrum Financial Group, we give innovative, honest, caring advice, and our partnership with you help us focus on and help get our clients to their goals. And thank you so much. It's such a pleasure. And I don't know when I might see you again, present or in person, but I hope it's soon.
Excellent. Well, take care. Thanks so much for the opportunity, and have a happy new year until we chat again.
Great. Thank you so much. Thank you, everyone.